backdrop of inflation data coming up this week, what's happening in the bond market, gold, ether. We've got a bunch of stuff to cover today. And anyway, this morning, we're talking cars. I bumped my camera and it's a little bit off right now. Like, but anyway, I want you to share what's your favorite car you've ever had, and it could be cool, it could be not cool. I've got a few of them. I talked about my 1980 Honda Accord. It was silver with red interior. The interior was in perfect condition. Wallet, but again, it was a lot of sun damage, and then the vinyl started cracking stuff. But it was a little rusted. But I had to begin working on cars back then because the gas tank was rusted out. So I'd keep having to change the filter, and then I didn't have any jacks, and I had to change I swapped out the fuel tank for another rusty tank, and trying to get the straps over the tank underneath that sucker in the summer. And then my brother unceremoniously totaling it. I had a 1989 Jetta, Wolfsburg edition, blue. Love that car. My dad, I had some issues with it. I needed to change the fuel pump, and it was like $250 for the pump and then labor. And I was like, so my dad talked me into trading it in for a Toyota Corolla. And I'm like, it pains me to this day to think of that moment of trading it in and losing it. And I wanted to buy a new one, but Cash for Clunkers thing mostly took those out. But I had a car that I've been looking for years. I had it for many years. And in 2016, I had a list of events, series of unfortunate events that happened. My dog passed away. My dad passed away. I lost my job at TD Ameritrade, and my car at that time was a 2003. I'm going to show you here, 2003 Land Rover Discovery, Bonatti gray with alpaca beige interior. It was parked on the side of the road just like this. It was on the other side of the road. Neighbor girl just got her license. She smashed it. She hit right here, and I think she hit the gas and the brake, or maybe just hit the gas, because she hit it here, almost ripped the wheel off. And then I think she recoiled and hit it again here and bashed it all the way down here into the rear wheel. And so the doors were smashed in, the tire was ripped off, almost ripped off. The sill and everything inside was bent with a Mazda Protege. And so I'm super excited, but unfortunately my plan was I wanted to do a lot of the repairs on this thing. So there's little things like I need a valve cover. They bumped the front of it, which it's very, very hard to find a bumper with these that aren't broken. So I'm going to put a metal bumper on it. But anyway, I was going to do some stuff, but unfortunately I decided last Wednesday during a youth church activity, because I'm one of the leaders, and we're playing cops and robbers. And I decided to try to grab the ring. I was a robber. I was going to cross the line and win it. And we're going to win it for my team. And this little 12-year-old stepped in front of me, and it was either him or me. And I'm like, well, I can't take him out. So basically I just jumped over him, kind of set him aside. So I was coming out of a spin move because I had flags on, and I took about 2 steps, like, oh no, I was home free. I jumped over him. I landed on my shoulder and had a grade 2 AC sprain and bruising. I'm all bruised up in here and stuff, but so I can't do the work. So I gotta outsource it. But we had a trip to Moab planned at the beginning of October. So we're going to head down there. We're going to do some slick rock stuff. So the question is, I want to get a lift on it, but I want to repair some of the stuff in here so we don't have as much leaky fluid. You can see the fluid down here where it's leaking. Valve cover is leaking. Not much else. I mean, usually they leak antifreeze and stuff, but I haven't really found any big leaks. But I'm gonna swap the water pump out. I'm gonna change the coils, which are on the back side of the engine, the spark plug wires, and along with the valve cover gasket, head gasket's good. So anyway, steering pump probably needs a little bit of shoot. I got 3 Amigos on, but I'm debating to do a 3-inch lift. I don't want to go too high, but again, these are virtually brand new tires the guy bought it from. So but I kept my high lift rack on and my cover back here. Probably should have taken some other stuff off the one when they uncertain. I should have kept it. Should try to fix it. I regret it to this day. But I finally found what's not an SE7. I put the Camel Trophy badge on right there. I bought it for my LR3, but I was like, oh, I look better on this one. So I got the Camel Trophy. I've got I got one coming from Malaysia. Another, I'm going to put a green tag right here on this side over here, and that'll probably be done. I got carried away with my LR3 putting too many metal badges. But anyway. All right. Yeah. So, again, we're not gonna do anything really significant like slick rock stuff, but we're gonna do some easy trails. So I'm gonna have my senior son, he's gonna drive one. We're gonna take both of my Land Rovers down. We'll drive it. My wife does not like the idea of having 2 Land Rovers, but it is a labor of love. So if you've ever had one, you know exactly what it's like. Cars you have to work on to maintain, although the LR3 is a very reliable vehicle. But I've had to swap, but it's got 190,000 miles on it. And so, I've had to swap out, control arms, linkages. And, I went up Boulder Mountain and ripped out my, ripped out my CV joints, had to replace that. And anyway, but it's fun. It was a little teaser about 3K. Yeah. So I bought this one for $7,000. Which isn't a great deal, but it's not a bad deal. I mean, interior's pretty good. The headliners, not bad. He repainted the hood. I've got the new OEM lettering I'm going to put right here across. This is Land Rover. But anyway, so if you've ever had a Land Rover, if right? It's like they just kind of like, they're super endearing. They're road manners, they're off-road manners. There's great cars to drive. And in this one, the command position, because you set up so high, the door jams like down here, it's like, but anyway. I'm not exactly a gearhead. I would love to, but I got all the tools. So I love collecting things. How are we doing, Daniel? But I do have all the tools to do this stuff. And I found this cool, I'll share this and move on. But I found this cool wrench. So it's about 15 inches long and it's gear driven. So basically it's like a ratchet, but you hook your drill to the end of it. And I couldn't exactly get the exact specs on like how much torque you can put through it, but I'm excited to use that to be able to get down in there and just put a drill on the end and unscrew stuff. But it is all metal. So I think it's, some stuff like that, you can't get a lot of torque through it, but I think I could get a decent amount of torque through this thing. So I'm kind of excited about it. Joe likes the Touareg. Yeah. And you got some Audi people, Porsche Cayennes. They'll kind of jack those up, put some nice tires on it. Apparently they're decent off-roaders, but driving up Boulder Mountain, this thing was, the LR3 does not have solid axles. This Discovery does, which I'm excited about. And so you get more articulation as you go over big bumps and rocks and stuff. But the LR3 does not. It has, and I took out the airbags. I regret it to this day. But I had, when you have a Land Rover, you have a mechanic. I don't have a mechanic right now. I have nobody I can trust. But I used to have this guy named Mike. He was in just South Salt Lake. And Mike was from Iran. And he worked on Land Rovers his entire life. You'd walk in there drive in there with your Rover. And he would just listen to it. And he'd say, this is what's wrong with it. This is how much it cost. And it was always fixed correctly. And he taught you how to maintain it. And so now I got to remember, I'm remembering things about how to maintain this 03 Discovery. The LR3s are he's like, just get an LR3. It's like, I drive New York and back, no problem. Anyway. All right. So, Audi A8. Yeah. So last year I got a BMW X3. It's a 2011. The valve covers on those things go easily. They're plastic. But so I had the guy change it before I bought it, and then it failed. So I did the valve cover job myself. I got an aluminum one instead of a plastic one. Hurt my gas mileage a little bit, so I've lost about 2 miles per gallon on it. But I love that thing, man. It's peppy. It's like light blue, metallic. The guy put 20-inch offset wheels, so I'm happy, and it's got a big sunroof. That's a good thing about that's why I got it. We rented a VW down in Volkswagen Jetta down in Delray Beach. I'm like, I like the big sunroof, so I went out there. Of course, you want all you want all-wheel drive here in Utah. All right, so enough talk here, but I love all the comments in there. You never said paint job. Well, look at this thing. I don't need a paint job. He did repaint the hood. That's why the lettering's not there, but I got the lettering. The paint is in really good condition. It's aluminum, so it doesn't rust. In the back, you got the big tailgate. The hinges on that do rust out. Interior, I gotta when I swap out the suspension, there's a tower in here that the suspension goes into. That's a little bit rust. I'm gonna have to replace that with a new strut tower. But anyway, the problem is like I'm not sure like how long it's gonna take my shoulder to get better to be able to actually turn a wrench. But anyway, so it gets that's the hardest thing with fixing cars is like it's super easy unless you can undo something, right? That's the hard thing. All right, let's take a look. 90 rubber band. Spent way too long on it. Sorry, folks. Internal versus external. We're talking stocks with a moving average. We'll scratch that. I don't think this is super relevant right now because we've already had that extreme reading. We're just backing off it. We haven't had the sell off yet. So we're just kind of a middling stage right now. We just need volatility. And for me in Ghost Prince, it's like, I just needed like, a couple more up days, couple more down days. And this would have been an awesome period. I like two-way action. The problem is the two-way, like Don talked about this morning, the two-way is really small. We're talking a really tight range in the market right now. And we're going to look at some stocks here. ETHA, KWEB, IAG, GLD, AMD, JD, KWEB, and IWM. A big roll up in the puts in IWM today. So looking like what? I mean, we're hedged right now, right? I'm like, there's significant risk. And as we talk about the 90 rubber band, we'll kind of talk about bonds just a little bit. In my video, I talked about some bearish prints in the bond market. Ghost prints, we did take a bearish trade in TLT as a result. And we'll see. But we got some big announcements this week. And Don talked about it today, and we talked about yesterday when I was on with him. I mean, there are some really significant things happening that could disrupt the market because I think we sometimes get too complacent. And I get it, right? I'm like, so when we talk about internal versus external trends. So let's take a look at we'll go SPX. So if we look at the SPX here over the last 5 years, so we'll go back to 2020. What has been the most significant driver for the market over this period of time? So we can see, yes, the market went from 2179 to 6492. But what has been the primary driver for the market over the course of the last 5 years? Does anyone know? Walter's talking about modeled. I have an original tool pouch in my attic. Nice. Joab says money supply. So when you say money supply, what you're saying is it's 100% about the dollar, right? It's not XLK. What's been the driver for XLK? Why can't I change mine? We're going to do that first. What's been the primary driver? Who's driven XLK? What companies have driven XLK? Stock buybacks. Who funds stock buybacks? So if we're talking about buybacks, what is the source of buybacks? You borrow and buy back, right? Right? What's led to NVIDIA? NVDA? We're talking about an upgrade cycle. Well, cycle for AI, right? Well, who's financing AI? Debt. So what are we talking about? All of this stuff that's contributed to the massive movement in the market has been 100% financed and fueled by debt, which debt creates an expansion in the money supply. So at the end of the day, are all of these things in the S&P 500 that are contributing to its performance, are they actually creating any value? Think about it for a second. Are all of these investments actually adding to the value of the S&P 500? And if so, how much value is it added? Well, if we look over this period of time, let's take a look at GLD. GLD since 2020 has gone from 145 to 335. What is the expected return on gold long term? So how much return do you expect to make on gold long term? What is the yield of gold long term? So if you have gold, how much money do you make it? How much money do you make on your gold? So we were having a chat discussion this morning in the main chat room during Don's session, prompting some of my discussion on this. But how much do you, so if you own a bunch of physical gold, how much money do you make on it? So if you store it in your home or at a bank, how much do you make on gold? How much yield does that gold? How much return on that gold does it? So gas on it's the same as the dollar devaluation. So the point being is this: gold has zero return, right? Gold does not increase in value, maybe incrementally. If suddenly we found a significantly more utility for gold, okay, we might actually see a demand shift to the curve, right? Otherwise, we're basically looking at what? Over time, if you own physical gold, you will actually experience zero returns unless you lend it out or lease it out, and you'll actually have a negative yield over time. Think about it for a second, right? Gold produces zero returns. In fact, the returns are negative over time, precisely because it takes money to store it. So it might be the cost of a safe in your house, and maybe that's the only cost you incur. Or if it's a bank, it's segregated and it's protected, and you're going to pay an ongoing cost to protect that gold over time. So if I take gold, which has no opportunity to really increase in value, and I compare it against the S&P 500, this is exactly right. When Tim says compared to gold, right? We're going to take the SPX and we're going to compare it to gold, GLD, and we're going to look at over the exact same 5-year time frame. How much real return has the market experienced? And what does that mean, real return? If you bought the S&P 500 back there at the sell-off point, right? If you bought SPX back in 2020 at the lows, how much has the purchasing power of your S&P 500 shares added? We've gone from 16.5 to 19.5. So what is that? That's 3 points, right? 3 points on 16. What is your real return over the past 5 years in the S&P 500? How much more can you purchase today? That hurts. Versus 5 years ago. It's appreciated 18.8%. Over 5 years. The S&P 500's only appreciated 18%. During 20 to 21, we saw substantial appreciation. Why? We flooded the market with money. And what happened was in 20 and 21, we pulled forward. We took all of that future potential return and dragged it back to the present. This is what the Fed does. They don't actually create anything, right? The concept and this notion that in economics, even on the CFA exam, well, the virtuous cycle of liquidity, that we somehow ascribe virtue to printing money, that somehow we say you can grow the economy through printing money. No, what you do is borrow from the future by printing money, because it's all financed through debt. So we pull forward all of this return, future return, 10, 20, how many years worth, to get a short-term pop in the market from 21 to 20 to 22. And since that point in time, we've just been giving it back to the tune of right now in the S&P 500, you've only generated an 18.8% return in 5 years. And that comes down to what? What can you buy with your S&P shares? You bought it 5 years ago, you hold it today, you sell it. How much more can you buy it? The fact of the matter is virtually all of the gains in the market comes down to what? It all comes down to dollar devaluation. So right here, 2021, we saw it significantly outperform gold. And then we started to really see the money supply crack open. We allowed those that had first access to money. Who had first access to money in 20 and 21? Who had first access to capital in 20 and 21? We saw stuff get filtered down in terms of like, we sent stimulus checks. So yeah, the little guy got some, right? But at the end of the day, it was Wall Street, right? It was Apple, Toyota Motor Company. In fact, down here at the peak of the sell-off, as borrowing costs were going through the roof for the biggest companies out there, right? Publicly traded companies, the Federal Reserve stepped in and bought their bonds. Apple bonds, Toyota Motor Company bonds, Ford bonds. They bailed them out at the expense of creating substantial inflation. So during 20 and 21, you had all these companies borrowing money hand over fist and to some degree investing on expansion, buying back stock to try to lift prices of their stock. But they borrowed money at such low rates in 20 and 21 that in 2022 and 2023 and 2024, these companies were making money on their borrowed debt because they're holding the cash and the Fed raised rates to the roof. Well, when did the Fed raise rates to the roof? To 5.5%. Let's go IRX colon CGI. When did the Fed start raising rates? Now, again, we had zero interest rate policy here, right? None of these companies were able to borrow at ZERP back here, right? Because borrowing costs exploded. Junk bonds, investment grade bonds, the spread between treasuries and corporates. But guess what? The Fed stepped in and bailed them out here. And then once we started to feel the carry-on inflationary effects, the Fed began to raise rates substantially. So by the time you had a chance to start to real borrow money, right? We started to see it kind of unfreeze a little bit. The Fed was raising rates sharply, the fastest in history, to 5.25% to 5.5% up here. So we mowed over Main Street, and yet at the same time, we're still providing reverse repo operations. We're not cutting the size of our balance sheet. We're actually expanding our balance sheet at times. We didn't do any of the first steps to bring in liquidity in the market, to pull back on the liquidity. All we did was take Main Street and smack him in the face in 22 and 23. And we're reticent to back it off right now, right? The Fed's not curtailing their balance sheet enough. We're at $600 billion, $6 trillion right now. And we don't want to cut rates, right? But now we might be on the cusp of a rate cut, but we now have another CPI report coming out this week. We're really, really boxed in a corner. And so again, some of the discussion this morning was about how, well, the market's been parabolic. Well, why? It's not because the S&P 500 stocks are creating value, right? Again, we talked about the issues with NVIDIA. When did NVIDIA peak? You can pinpoint the day on NVIDIA when they peaked. It was right there. It was June 20th, 2024, but we're higher today. So what? Right? The reality is all of these companies we bailed out in 2020, the biggest, the Mag 7 companies, we put in place all of these policies that favored them, right? We killed Main Street by not allowing smaller companies to operate, and then we killed them by raising rates to the extreme, mowing over Main Street to try to cure an inflation problem that was created precisely because we stepped in and provided massive amounts of liquidity in a very short period of time. And we're still trying to soak it up a little bit at a time today while keeping rates at very, very high levels. Now, here's the problem, though. We have a CPI print coming up this week. What's the market about to do? What if we actually put in a higher print? What happens to the bond market? 30-year treasury yields have been coming in. Why have people been buying treasury bonds, long-term treasury bonds? Well, we're anticipating a Fed rate cut, right? So right now, if you look at the yield curve, so short-term to long-term, it looks like this. Don brought that we talked about this yesterday, right? Well, this right here, if the Fed cuts rates, it's going to immediately crash lower with the Fed rate cuts, right? But what's happening out here? The middle, the 2-year to 7-year, for example, right here in the middle. Why is this what we're talking? This is what? This is yield, right? And this is maturity, length of time. Why is the sagging? Because we're pricing in rate cuts going into next year. Significant number of rate cuts. 1% plus. We're expecting the Fed to really kick it in gear here. This has been falling in here. We're seeing it right there. We're seeing a breakdown in anticipation. Hey, the jobs market's weak. A weak jobs market is generally coincident with recession. Okay, so at the end of the day, we're pricing in significant rate cuts. Now all of a sudden we're saying we're not concerned about inflation. So we see a huge bid in the treasury bond market over the course of the last week. And we have an inflation print coming up tomorrow in PPI and CPI on Thursday. So when you look at something like TLT today, right? When you look at something like TLT, let's say you have a softer inflation print on Thursday, CPI. Let's say inflation comes in less than expected, which right now is 0.3%, which is and the year-over-year rate's 2.9%. We're well above the Fed's target rate of 2%. But let's be honest. The Fed has implicitly been targeting 3% since 2020. They may say otherwise. They said they'd be willing to accept a higher inflation rate for a period of time. They're still accepting it. They've not done anything to kill it, right? They've not taken the bigger steps of reducing their balance sheet quickly because they don't want to sell treasuries. They don't want to upset the borrowing capacity of the U.S. government. But now all of a sudden we have a labor issue, which frankly has been going on for 2 years. We overstated the jobs added by 1 million jobs last year. Looks like we may have overstated 800,000 this year. This is a persistent problem. We now have more jobless than job openings. Not everyone's qualified to take every job out there. But now we have an inflation print. Well, what if we come out higher than expected? We've already priced in that the inflation's not a problem for right now over the last week since the jobs number, right? We priced that in here. Now what? Well, the reality is the upside in TLT, from my perspective, if we have a lesser than expected CPI print, which is not a certainty, the upside might be relatively limited. But if we come out in line, we might just get a normal pullback or retracement here in TLT, or we might have a hotter than expected CPI print, and we might actually have a sell-off because TLT is not as affected by the Fed policy in terms of interest rates, but they are affected significantly due to inflation expectations. Now, maybe they overlook it, but to see a short-term pullback, 88, 87. So yesterday, I talked about it in the video yesterday, but look, we had significant prints for 12 SEP and for 19 SEP buying the 88 puts. Buying the 88 puts. Now, what happens if all of a sudden we have an inflation print that's hotter than expected and the Fed is boxed in a corner and maybe can't cut, or if they do cut, I think next week, maybe they can't do the follow-up cuts. What do you think happens with the dollar in that case? So if all of a sudden the CPI comes out hotter than expected and we start to back off the cuts here and we start to see selling in the treasury market, what do you think potentially happens in short order after that scenario? the dollar may gain significant value. Initially, might see some weakness with the treasury selling, but the fact of the matter is, if yields start to go up, it will pressure equities, right? It will begin to pressure equities again. They're heavily indebted. The dollar may then begin to surge. And all of the mirage of the S&P creating value for investors goes away. You suddenly realize the emperor has no clothes. We printed $9 trillion. We expanded the balance sheet to $9 trillion, expanded the monetary stock by $5 trillion in short order. And then you have the multiple. As that gets into the banks and the banks lend it out, you can lend out multiples. There's no reserve requirement right now for banks. They don't have to hold any money for your deposits, for example. That was done away with in 2021, by the way. So the point is this, is that anything you perceive to be strength is purely what? Based on our ability to ever expand debt and devalue our currency. And gold is representing that very, very perfectly. But in this scenario I just laid out of a stronger dollar, guess what? Gold does not hold up. Gold could readily pull back 30%. Sure. It all depends on how big the credit issues become. And if they do step in, they do cut rates in the midst of that, what kind of systematic issues do we encounter? Don shared the story this morning of with Think or Swim back in the day, and now I forget. Now I forget the clearing company. Okay, it was almost a crisis. Yeah, it was almost a crisis, and eventually we will experience the other side. So we don't know how much, but as we look at the VIX market right now, is the VIX under Citadel? Thanks, Joab. Citadel almost got smacked big time in the financial crisis. Yes, they let Bear Stearns go, but then they bailed out Goldman Sachs and Morgan Stanley, right? They let Lehman fail, but they bailed out Goldman Sachs and Morgan Stanley. They allowed them to become banks when they didn't qualify. Well, they could have done that with Bear Stearns and Lehman. They let a little bit of bleeding occur. And again, the market, we had a crash and came back. But the VIX right now, is the VIX underpricing or overpricing the movement in the market? What do you think? Is the VIX underpricing or overpricing the movement in the market? Joabs is under big time. All right, so look at right now. So the VIX right now is basically at lows, right? 15, I would say at lows. So I'm going to use what's called the ATR indicator. We're going to look at the S&P 500. I gotta watch, keep my track of my time here. So we're gonna come in here. I'm gonna go to I'm gonna go to studies, edit studies. Okay, we're bringing up the ATR. I will use the ATR as a comparison here, right? So if we look back, this is on a daily basis, right? Where are we in terms of daily range? So our low point occurred back here in the end of July. Okay. So end of July, it was about 44 points on the SPX. We're currently at 52. So are we near the lows? Yeah, we are, right? What about weekly ATR? ATR has been coming in since we had the sell-off here. This does lag a little bit, right? We could kind of come up with it right now. It's about 161 in terms of a weekly ATR. But this is going back 14 weeks. So we're still probably catching a little bit of the volatility in April. What if we change this a little bit and say, okay, what about over the last, let's just take a 4-week ATR. Okay. Well, let's go back. Let's go 6 weeks. So right now we're seeing on a weekly basis, the ATR is the lowest it's been since when? We'd have to go back to December of last year. So are we realizing significant volatility? No, right? But this is lagging a little bit. But what Don showed yesterday is pretty significant. So I'm going to clear out my studies. And again, so again, we have internal, external, right? We're kind of trying to read some things in by looking at, is volatility expanding at the top here? The answer is not really, but if we look under the surface a little bit, what we are seeing is that if we look, just going to bring the auto expected move here, and you look at last week. Okay, so last week right here. No, it's not last. Yeah, sorry. Yeah, it's the first. So we look at last week. You'll notice that the weekly bar almost engulfed the entire range on the expected move. Okay. And so again, what you're seeing right now is volatility. This was a big week back here as well, right? This was a pretty big week, but did not fully get the full range. This was a big week, but again, we traded down, we traded up. So from an ATR perspective, we're taking the range of that with a low VIX. The range between the total movement with a low VIX is relatively small. So we're really not pushing the envelope compared to the past, but we are pushing the envelope given relatively low volatility expectations. And right now, this week right now, we ain't moving at all, right? We're not moving at all, 0.02%. So what's the chance that this week that we get a move to touch the upper or the lower? And the fact of the matter, the longer we stay in this range, okay, the bigger the move over the shorter, the same move is going to happen over a shorter and shorter period of time. The chances of a breakout here and here, and again, we've got two big data days, PPI on Wednesday, CPI on Thursday. So when we look at what's happening, again, the internal trend of the market, VIX 3M divided by VIX, we're looking at volatility expectations, and we're looking at it right now at the VIX here. Right now, we're pegged above 1.2 again. We're seeing persistent high volatility expectations since when? Since July 23rd. But the reality is the breadth of this rally has been terrible. The dollar's weakness, as represented by gold strength, has curtailed any real downside for now. But now we have a key event coming up this week that could really change things. Okay. Isn't the market always correct where it's supposed to be? I'm not sure exactly what that means. So is the market priced accurately here at on SPX? What determines the price? So over here we got 64.97. What is that priced in? So what we're having right now is a value versus price, right? So what are we priced in over here? Supply and demand determines price, but supply and demand for what? What is this priced in over here? So if I look at the SPX, what am I converting? Yes, it's US dollars. So when I look at this, I have two effects, okay? When I talk about value, the S&P is going up and down in value. The US dollar is going up and down in value. Each one of these individually equate the dollar price, right? The price in dollar terms. So the problem is when we talk about SPX, and if you're only looking at stocks, right, and you're assessing valuation, you're only looking at this. But when we actually look at value, and because this does not represent value, this represents the dollar price. So if our focus is looking at exclusively the price of the S&P 500, and we infer that somehow that represents the value, it doesn't, right? There is a price and value. There's a price and value, not the same thing. So even if you think the market is fairly valued at current levels, the fact of the matter is the dollar price can be affected just by changes in the dollar's value. because the outward external trend of the S&P is reflecting the dollar price. And we know that most of the return in the S&P 500 since 2020 is purely about the dollar losing value. What happens if that reverses? What would cause it to reverse? A credit crisis. So all of the debt that led to a massive expansion in the dollars available, the dollars in the system that led to inflation, all of a sudden starting to evaporate, and demand for dollars expanding. What causes demand for dollars? There's a tremendous amount of foreign debt that's denominated in dollars. It is still the reserve currency. So as a result, if we experience a global credit crisis, the dollar is going to necessarily go up. Even if the value of the S&P doesn't change, the dollar price of the S&P will cause it to change. Are we having any sort of indication? We're seeing the dollar get demolished here this past week, 2 weeks, since the Jackson Hole statement back here, even a little bit before, but around, I think it was Jackson right there on the 22nd. Since Jackson Hole, the dollars got smashed. S&P's done nothing, right? We got that pop right there. We're barely higher post Jackson Hole on the 22nd. We're up minimally right now. We go from the prior day's close to the current value, we're up 2%. Gold's up significantly more. So we're seeing is that the S&P 500 is diminishing in value despite the dollar getting smashed. And we can see the erosion in value happening right now. How do I see it? Let's bring up the RSI study set here. What do we call higher highs on the price and lower highs on your indicator? What do we call that? Does anyone know? Weak, we got semi-strong and strong. I had to write a bunch of questions around efficient market hypothesis. I hate efficient market hypothesis. It's stupid, right? It's called the divergence. So here's the irony, right? The dollar's tanking right now, right? The market is barely getting out of its own way. And as a result, we're seeing a divergence. What's happening right now, the value of the market's decreasing. The price is going up exclusively because the dollar's grinding it out. And we're seeing that we're seeing a very small set of companies driving the market. What happens when all of a sudden the loss of value, real value in the markets, all of a sudden starts to materialize as the dollar strengthens? Again, a key data point this week, because we know we're likely in recession right now, folks, right? We know we're likely in recession right now. We also have what's called a what? Rising wedge going on. Now that target would be right here, right? So again, what we got from the jobs market suggests that we're right on the door of recession today, right? And maybe the last several months. The value of the S&P 500 is probably starting to price that in a little bit. The price isn't because the dollar's getting smashed. Once the dollar strengthens, all of a sudden, you'll start to see volatility, because what's been priced in on the internal trend is going to start to manifest itself in the external trend. It's already manifesting a little bit, but again, divergences, I would still call the internal trend because we're still forming higher highs and higher lows. This is not a bull market, folks. It's just a bullish trend, a trend that divergences tell us are weakening. Okay. And so bull market is a totally different definition than a bullish trend. The two are not the same thing. So again, you've got to consider the internal trends. And right now, skew is high, right? Institutions are hedging. They're pricing in high volatility, and the dollar's weakness have just delayed the manifestation of downside volatility. How long can we keep going at that clip? Even if gold goes sideways here, right? The dollar just starts to hold its value, not lose as much as we're seeing here. The S&P goes down. Why? Because it's losing value right now. right? In real terms, it's losing value against gold. All right. So let's take a look at some stuff. I want to start off with IWM. Spent way too long in that. Well, actually, I was planning on taking a half hour on that, but I spent 15 minutes talking about cars. So Mario says, what if we're at zero or negative population growth plus aging? Yeah. So, I mean, ultimately, I mean, we're running into some demographics issues almost globally, right? Except for, the African continent. I mean, like, you look at the potential. I mean, Nigeria is a big country, right? We kind of do a monolith of Africa, which is entirely ridiculous. I mean, does France define Europe? Does Germany define Europe? Well, I guess it does, because you have European Union. Their interests are espoused over the interests of the southern countries. But in Africa, you don't have that same monolithic government that tries to favor France and Germany over the periphery, right? Anyway, Walter says, always talk cars. Anyway, so let's take a look at IWM today. So I'm going to show you here. I'm going to bring up the Ghost Print scanner here. Oops, there we go. We're going to bring up IWM. That wasn't come up. Oh, it just took a second to load. Sorry. We'll bring up IWM. Now my internet's like, there we go. All right. IWM. What happens today in IWM? What's going on? They're buying 53,000 contracts. Again, the open interest was 7,000, 7,800. It took a 50,000 print likely to hop over that value. It traded at the ask. It was for September 19th. It was a 233 puts. Did anyone see that today? So you want to be bullish on the market. I get it. It's easy to just buy and hope for the best, right? And the market rewards you for a period of time. The realities of that strategy is it just doesn't work over time. Because if you've owned the S&P 500 since 1996, you haven't made any money. So if you bought the S&P 500 in 1996, you've held it to today, the purchasing power of those shares have not gone up. It may have actually gone down. So the fact of the matter is, buying a bunch of stuff indiscriminately, buying the good, the bad, and the ugly has been a losing strategy now for 30 years. Well, at least 30 years. It has been a losing strategy, right? The financial engineering, the behavioral finance people have lied to us for 30 years. Okay. If you bought the S&P 500, you diversified, you've failed. It has not kept up with the inflation in the market. Your purchasing power actually went down. So the fact of the matter is, what are they doing? They're buying puts. Don talked about it this morning, and I fully agree with it. What is the number one thing you need to be doing right now? If you held cash, that has been wise. Yeah, you didn't take any risk. But the reality is the cash actually lost, right? So holding cash didn't work. So the problem is we're put in a pickle, right? Put in a pickle. Only 30 years? Yeah, but I mean, I go back to when we really began this really change in monetary policy. Okay. Cash got smashed. You did not want to hold cash. I mean, at least stocks treaded water. Cash did not. Purchasing power went down a ton. So cash was not king. Holding equities preferable. Holding gold was the answer, right? Lower volatility, maintain purchasing power. Anyway. So if we look at IWM here, right, we're down 0.92% today. What is this telling us? It's telling you better start to cut what you, in Ghost Prints, we took KWeb off today. I took it off right after the open. And I took it off right here. I took it off right there. It went up another 60 cents. In fact, someone posted they got a buck 4 out of it. But you know, I'm less than 2 weeks to expiration and I can get a 35% return right here. I'm going to do it. I didn't care about what other opportunity might be there. I had to take it off. If I had another month, I wouldn't have done it. But I have a little over a week and a half for KWeb. And there's a lot of big prints coming today in KWeb, right? KWeb, JD, Baba. There's a lot of prints, bullish prints today in these Chinese stocks. So again, from my standpoint, the AI play after NVIDIA's earnings was KWeb. When did NVIDIA announce earnings? Options market has confirmed that. NVIDIA announced earnings on the 27th of August. How has KWeb performed since then? Now, we were long KWeb before that. We go back to the 24th of August. We're right there. 24th. What was it? NVIDIA. It's 27th. Sorry. The 28th, we began to see the move. So 28th. What have we seen since the 28th? Where is it? It's right there. So on NVIDIA's earnings, I talked about with Johnny. So look, the play for AI is China, right? Chinese AI companies. But again, right now, we've seen huge outperformance. I'm not rolling right now because if the dollar strengthens this week, this is going to get smashed. Why is KWeb going up so much? Does anyone know? What is the strength? So Daniel, as far as 8% a year, yeah, I mean, let's just look at it in gold terms, right? How much is gold appreciated? That tells you, right? Why are Chinese stocks performing this well? So you're seeing a hedge right now in IWM. They rolled up puts, right? A lot of them skews higher, right? What is the primary driver right now? I'm going to show you right now. What has been the primary driver for Chinese companies? Are Chinese AI companies profitable? Are they killing it right now? I mean, that's assuming you actually trust the data, which is hard to do. Let's look right here. What has caused the outperformance in the Chinese companies? Notice what happened back here on the 1st of August. Dollar began to strengthen and boom, right there, 4th of August. We have seen a one-way street, right? The Chinese yuan is increasing against the dollar. It's gone from 1386 to now 1404. That's a big move. Well, how does this compare against the past, though? Let's zoom this out here and we'll see. Zoom. How does this kind of move compare against the past? This was a bigger one, April through about May of this spring, right? That was a bigger one. Go back to 2025, 1364, peaked up here at 1394. How does this move compare? 1386 to 1404. We're talking about, 20 there. We're talking what here? We're talking about 30. That was an intraday spike and fade. We actually were down here. We're seeing as we saw similar moves in the dollar, the yuan against the dollar once last year, again in April, for example, and it propped up Chinese stocks for a period of time. How long did that last? I mean, this is kind of a big deal. I mean, let's zoom back out here, right? What happened here? Oh, Chinese stocks went 38.50 to 27. Back here, we went from 39.5 dropping to 27. All it takes is for the dollar to strengthen vis-a-vis the Chinese yuan, and we're going from 40 maybe to 27. So we have the mirage right now of foreign stocks doing well. Why? Because the dollar's getting smashed. All it takes is for the dollar to strengthen, and these companies are going to come down hard. Do I want to stay long KWeb despite the prints this week? Yes. Are institutions pricing in the dollar's demise? Yes. That's why you want to hold foreign stocks valuation. But do you want to hold Chinese companies for valuation? No, you can't really trust it. But do you want to hold them because the Chinese yuan is strengthening against the dollar? Yes. It's called currency risk. When we talk about foreign stocks, currency risk is big. Okay. And so as we kind of look through, the dustbin here, right? And I'll show you my log for today, but they're buying ETHA. Okay. Buying calls in it. We're kind of consolidate. It's kind of interesting. It's hard for me because playing a call spread, there's no real edge in that right now. Buying BABA, struggle, right? All of this stuff, buying IAG, it's a gold stock. Rolling AMD, we're taking profits in AMD by rolling it out. Sorry, actually, this is a cost. They're rolling it out in time because they're bumping up against expiration here. They're buying calls in JD. They're buying calls in KWeb. They're rolling up their put hedges in IWM. So here's the thing, though. Right now, it's about what? Reducing your exposure to the market, trying to take off this inventory. You're seeing it right there. They're removing the current expiration inventory for September 19th. They're trying to extend the time. Okay. So, but we do have significant risk with CPI. Do you want to get out ahead of it after they've already made big moves in China? Probably not. ETHA, it's kind of interesting, but it's highly correlated to the market. So this is where you probably play a little bit duck and cover. So we went bearish TLT. There might be a reasonable opportunity today. There's a big roll in GLD, rolling further out of the money, profit taking. This might be a reasonable short opportunity just to kind of carry it back to 327-ish. But we took TLT yesterday, and we'll see how it plays out. But again, event risk for the week. What do you think, Blake? Do we want to amp up the level of risk in the market and our risk of our portfolios, or are you dialing it back?
I've got to dial it back, especially with the fact we responded to a very obscure news report. Didn't even make it to some of the calendars. So it seems to me like we are. I mean, and you saw the tape: highs, lows, highs, lows. So lots of low shadows. I think you have a higher risk. I think you need to dial it back. It's just what it is. Dial back the risk, protect your trades, define risk strategies. I think are the way to go right now.
So again, like the temptation right now is to dial it up bearishly, bullishly. This is where hopefully you've kind of put some stuff in positions. You're looking to close it out, dial it back, take some swings, but I agree
Yeah.
with you.
Oh yeah. And I'm just saying you be calculated. You got to be calculated in all
Exactly.
of your risk
Yep.
and define risk every single time. The fact that the dollar strengthened today across the board off of worse than expected revisions on labor, that doesn't make sense. So this is a rush to, we don't know what we're doing. So as far as the market reading fundamentals, the market saying, I don't know what to deal with. I don't know what to, so obviously I priced it in wrong. And so even though it's priced in the right direction that you would expect, I think the market's saying, I don't know what we're doing with this data. If we don't know what we're doing with this data, I need to pull back. And I think that's why you see that response, that we went to cash, we fled to cash, which strengthened the dollar temporarily as they're repositioning, reevaluating. That's what I see it as. So we as the market do not know what we're doing with the data. We overpriced in one thing or the other. And so now we're trying to figure out how do we reposition again. And so that's when people are repositioning, it's better to be safe. I commented on this yesterday. It's better to be not in a trade you wish you were in than in a trade you wish you weren't in.
Yeah. And I think your point is correct. I'm like, we priced in the last week in gold and bonds. Big cuts, right?
Yeah.
And again, we're pricing in recession pressures in the bond market. So it's like, that to me is the opportunity, is like, we've already priced a bunch of stuff in that may not happen. And so even if we get news that's favorable, it's already priced in. So I think there's two pathways to the downside, one to the upside. But at least this might be, if you're long gold, to take some profits this week, maybe.
Yeah. And I mean, from the intraday, we tagged the upper level on that response. We just tagged it and came back down. So just the intraday, it's there. And I think what did I have as my target? I talked about this on the long term, and not ally. I don't need ally in there. I need gold in there. So gold from the top side, we said we're going to fair price. I even commented 36.91 fair price here. We had the short term through there, and we said if we break out, we're going up through there. And then intraday or intra week, we need to break through here, but this is the area from the week. You want to take profit. You're at fair price here and fair price here. So this is kind of where it'd be a good place to protect.
Yeah.
Doesn't mean go short. There's no sign here for me to go short yet, even on that response. So.
Fair. All right. We'll see you folks.
All
Have a
right.
great Blake.
Thanks. Appreciate it. All right. Well, I wasn't going to start with gold, but we'll